Treasury yields continue their downward trend today as investors grapple with an unprecedented data vacuum caused by significantly delayed economic reports and look ahead to future data releases that could solidify expectations for further interest rate cuts by the Federal Reserve. This period of uncertainty, largely a consequence of a protracted U.S. government shutdown in late 2025, has left markets operating with incomplete information, fostering caution and a flight to the relative safety of bonds. The yield on the benchmark 10-year U.S. Treasury note has fallen to its lowest level since the Federal Reserve's hawkish policy meeting in December, with a substantial portion of this decline occurring after softer-than-expected services sector activity data. This drop reflects a market increasingly pricing in a cooling U.S. economy and anticipates further rate cuts from the federal market. Participants are keenly awaiting guidance on whether a softening jobs market will prompt earlier and more aggressive rate reductions, or if the Fed will hold off until later in the year. The consensus forecast for January's job creation is 170,000, lower than December's surprisingly strong figure, yet still considered solid. The current predicament stems from a 43-day U.S. government shutdown that concluded in November 2025, halting the collection and dissemination of crucial economic statistics. Key reports such as gross domestic product, GDP, the Consumer Price Index, CPI, and monthly jobs reports have been either delayed or, in some cases, canceled entirely. For instance, the October CPI report was canceled, and the November CPI release has been pushed back until after the Federal Reserve's December monetary policy meeting. This lack of timely data creates a significant blind spot for investors, complicating asset pricing and obscuring the true direction of economic growth and inflation. This data fog has several implications for the market. Firstly, it amplifies volatility, as every belated data point, once released, tends to trigger outsized market reactions. Secondly, it severely hampers the Federal Reserve's data-dependent approach to monetary policy, potentially leading to a more cautious stance on interest rate decisions. Investors, typically reliant on official statistics, are now turning to alternative data sources and adopting more defensive asset allocation strategies, such as increasing demand for short-duration corporate and municipal bonds to lock in yields before anticipated rate cuts. The long-term impact may include a renewed emphasis on robust economic data infrastructure and a shift in how investors gather information, prioritizing diversification and resilience. While the broader view suggests the U.S. economy remains resilient, the risks to the outlook are elevated due to this informational void. The ability of the market to absorb and react to a concentrated influx of delayed information will be a key test in the coming months, determining whether the current fall in Treasury yields represents a temporary repositioning or a more sustained trend driven by a genuinely slowing economy. UBS analysts, among others, expect Treasury yields to fall further as the Federal Reserve resumes policy easing later this year.